Hello, I'm Ali, and in this lesson we will talk about the concept of materiality. ACCA 320 requires auditors to consider materiality in planning of the audit and performance of the procedures. Materiality is a key auditing concept and is assessed during the risk assessment phase of every audit. The preliminary assessment of materiality guides audit planning and testing. It also helps in assessing the validity of information contained in the financial report and notes to those reports. So what is materiality? Any information which impacts on the decision-making process of users of the financial report is considered material. This includes the information that's misstated and information that's omitted but should be disclosed. Information could be considered material because of its qualitative or quantitative characteristics. Information is considered qualitatively material if it affects a user's decision-making process for a reason other than its magnitude. For example, a fraud by its nature is considered to be significant, and when uncovered, is investigated further by the auditor. The next example is companies' non-compliance with laws. It's considered material because of its nature. According to Australian Accounting Standards 1031, a change in accounting method and related party transactions are considered qualitative material. When reading the notes to the financial report, the auditor assesses accounting disclosure accuracy and compliance with any regulations and legislation, and ensure that any legal matters that should be disclosed are disclosed correctly. If any of these disclosures are inaccurate or omitted in error, the auditor will consider the potential impact on users. If the auditor believes that an inaccurate disclosure or omission will affect a user's decision-making process, it is considered to be qualitatively material, and the auditor will request that the client amends the disclosures or includes any omitted information. Information is considered quantitatively material if it exceeds an auditor's preliminary materiality assessment, which is set as a percentage of a relevant base. An auditor uses professional judgment to arrive at an appropriate planning materiality figure for each client. Planning materiality is a percentage of an appropriate base. The auditor selects an appropriate base and then decide on the percentage to be used depending upon the client's circumstances. Audit firms vary in the method they use to set materiality in the risk assessment phase of the audit. In balance sheet, the common bases are total assets or equity. The common bases in income statement include profit before tax, revenue, or gross profit. When it comes to selecting an appropriate base for the client, the auditor considers a lot of things, such as what is the key driver for the company? A key driver is something that has a big impact on whether the company does well, or a key driver is a leading factor affecting performance for a company. What are the company's objectives? What is likely to be a stable base because normally auditor likes to choose the same base year after year. Also, the auditor might consider what's predictable and relevant for the client. So now we'll look at first base, which is profit before tax. It's relevant for most public listed companies because it drives dividends and return on investments. However, profit before tax is not an ideal base for non-profit organizations such as charities. Non-for-profit organizations do not earn profits for its owners. All the money earned by a not-for-profit organization is used in pursuing the organization's objectives. Therefore, profit before tax is not selected as a base for those sort of entities. For a loss-making firm, profit before tax is not selected as a base because they are going to be a negative figure in the income statement. The other thing, profit before tax is relevant. However, it might not be stable. It can change a lot from year to year. It can go up and down. For an entity where profit is fluctuating a lot from year to year, then profit before tax is not an ideal base. Revenue can be relevant to a lot of firms because most of the firms want to increase their sales. But the main problem is it can fluctuate a lot depending on the business, especially when it is a seasonal business. The next one is a gross profit, which is definitely relevant. It is relatively predictable as well because the percentage change in cost of goods sold and percentage in revenue trend tends to be fairly consistent. The next is total assets. The beauty is it's very stable. For example, PPE, plant and equipment, the PPEs do not tend to change too much, but it's not a great base for service firms because there are not a lot of assets for them to use. Total equity. The good thing in here is it is very stable. It does not tend to move much. Next question is it relevant? Most firms do not use equity indicators as part of their KPIs for managers' remuneration. So the auditor has to pick something that motivates managers and shareholders and is also stable, relevant, and predictable. As a result, for majority of the publicly listed companies, profit before tax is commonly used as a base for calculation of preliminary materiality amount. AASB 1031 provides guidelines on the percentage to be used when calculating materiality. Any item that is 10% or greater of profit before tax is considered to be material. Any item less than 5% of profit before tax is considered to be immaterial. The materiality of any item between 5 and 10% of the profit before tax is a matter of professional judgment for the auditor. When using total assets or revenue as a base, which is a bigger number, the percentage fall to 0.5 to 1%. And when equity is the base, the percentage is from 1 to 2%. Most audit firms have their own guidelines for their staff to use. The other important thing is that the auditor has to select only one base for the planning. That means they do not need to select a different base for balance sheet and for income statement. Whichever base is used, there is a percentage above which items are deemed to be clearly material, a percentage below which items are deemed to be immaterial, and a range in the middle that is a matter for an auditor's professional judgment. When setting a lower planning materiality level, an auditor increases the quality and quantity of evidence that needs to be gathered. The lower the materiality level set, the more items will fall into this definition, means more likely the auditor will conclude that misstatements are material and further testing is required. And in the next video, we will talk about client approaches to measuring performance. Thank you.